faithfully delivering value and interpreting great books from around the world. Hello, this is Sally's Book Talk. Today, I'm interpreting a book for you called The Phantom of Wall Street, authored by Arthur Simpson. In 1996, on an American Futures magazine's website, a person's post was hugely popular among professional traders. He had many fans, but he never wanted to reveal his identity, only appearing as the Phantom in the trading circle. This username showed up on the forum. The book, The Phantom of Wall Street, is all dialogues between the Phantom and his assistant Arthur, mixed with feedback from forum users back then. It might seem a bit messy in form, but their talks are super valuable for futures traders in real practice. The author of this book, Arthur Simpson, is the Phantom's assistant. Since 1971, he's been a member of the Chicago Board of Trade and a registered floor trader with the National Futures Association. In the book, the Phantom talks about how over the past 30 plus years, folks always asked him for, his trading secrets, and he always shared everything openly. But he didn't want the spotlight. He chose to be the shadow behind others' trading success. That's his only wish. His over 30 years in trading taught the Phantom that to succeed, just having the right knowledge isn't enough. You got to consciously change some of your own habits. The Phantom told Arthur a story about his little brother when he was a kid. Once, his brother went to play at the blacksmith and saw the blacksmith holding a horseshoe with long tongs. At that point, the Phantom's mischievous brother actually walked up and reached for that horseshoe, only to toss it right to the ground. The blacksmith turned to the Phantom's brother and said, "Too hot, huh?" His brother replied, "I never want to look at it again." The kid got mischievous and touched that horseshoe. His hand must have been badly burned, so he'd surely learn his lesson and never touch a hot horseshoe again. The Phantom told this story to show that traders also have horseshoes they shouldn't touch. So, what are the horseshoes that traders shouldn't touch? Now, let's get into the core of this book, the explanation of the Phantom's 3 big trading rules. The answer will come clear. The Phantom's first rule is to only hold correct positions. Most traders start by assuming they're right, then let the market prove them wrong. In most cases, the market will indeed prove him wrong, because trading is inherently a game with more losses than wins. The Phantom believes traders should first assume they're wrong, then let the market prove them right. If after placing an order and waiting a while, the market doesn't confirm your position is correct, close it immediately. Many traders will say, before placing any order, I've carefully considered it and have a solid trading system. I only enter when I see clear signals, but this often overestimates the probability of success. In futures trading, there are countless examples of people starting with $5,000 and making, tens of millions within a few years. But it must be said, far more traders lose all $5,000 in just months or even less than a month. So after opening any position, traders shouldn't first calculate potential profits, but instead focus on protecting your principal. Remind yourself you might lose big in this trade. This behavioral shift means closing wrong positions early. Protecting capital by staying uninvested is correct behavior. If you wait for the market to tell you your position is wrong, by then that mistake will already be bleeding your account. The most crucial thing in trading is achieving small losses and big gains, not big losses. The Phantom knew a trader with a 70% win rate who still lost money. Why? Those 70% of his trades were winners. The profits were small, while the losing 30% each cost him big money. Conversely, even with over 50% small loss trades, if 30 to 40% are big winners, your overall account will be profitable. Traders often use stop loss orders, setting automatic exit points when opening positions. For example, going long at 100 points while setting a stop loss at 90. If prices drop to 90, the system automatically exits. The Phantom sees this as passive, not proactive, loss cutting, but being forced out by the market, often after significant damage. Actually, in most cases, the market will indeed prove him wrong. Because trading is inherently a game with more losses than wins, the Phantom believes traders should first assume they're wrong, then let the market prove them right. If after placing an order and waiting a bit, the market doesn't confirm your position is correct, just close it out fast. Many traders will say, before I place any order, I've thought it through carefully and have a solid trading system. I only enter when I see clear signals, but this often overestimates the chance of success. In futures trading, there are countless folks who start with 5 grand and make tens of millions in just a few years. But honestly, way more traders blow through all 5,000 bucks in months, or even less than a month. So after opening any position, traders shouldn't first be dreaming up profits. Instead, focus on protecting your capital. Remind yourself you might lose big in this trade. This habit shift means closing wrong positions early. Protecting funds by staying uninvested is the right move. If you wait for the market to tell you your position is wrong, by then, that mistake will already be bleeding your account dry. The key in trading is aiming for small losses and big wins, not huge losses. The Phantom knew a trader with a 70% win rate who still lost money. Why? Even though 70% of his trades won, the profits were tiny, while the losing 30% each cost him big bucks. Flip it around. Even if over 50% of trades are small losses, as long as 30 to 40% are big winners, your whole account will profit. Traders often use stop loss orders to close positions, meaning setting automatic exit points when they open a trade. For example, going long at 100 points while setting a stop loss at 90. If prices drop to 90, the system auto exits. The Phantom sees this as passive, not proactive loss cutting, but being forced out by the market, often after heavy losses. They pointed out that if they followed the Phantom's approach, most of their positions should be closed immediately after entry. But operating this way would rack up significant transaction fees. And to this, the Phantom responded. He gave an example. After the Dow Jones rose 30 points, I went long, expecting it to gain 10 more points within a minute. When it didn't, I closed the position within that minute. In this trade, I lost 1 point plus fees, but the market kept falling. Had I held the position, the loss could have been 30 to 40 times the fees. Clearly, traders with limited capital would get wiped out fast if each trade lost big chunks of principal. So how do you judge if a position is right or wrong? The Phantom offered a reference standard. For example, a futures product opens at 600 points today. You go long at 605. 3 conditions must confirm your long position is correct. First, if today's open is lower than yesterday's close, prices must rebound within the first half hour. Before the morning close, prices must break yesterday's high. Second, during the first half hour, prices must stay in the upper half of yesterday's trading range. Third, by the morning close, your long position must show at least a 3-point profit. The first 2 conditions ensure an upward market trend. The third confirms the bull market is strong enough. In this case, the buy price is 565 points. If the morning close is above 608 points, 3-point profit, hold this long position. But if it closes at 666 points, exit immediately. Don't keep it. Crucially, the Phantom's correctness criteria are separate from entry signals. For instance, in our example, your long entry was at 565 points. What technical signals you use to enter are your trading system's business. But after placing an order, if the market doesn't move as expected, exit immediately. Cut your losses fast. So according to the Phantom's first rule, traders must proactively close positions at the first sign of trouble. minimizing losses and cutting fast. This approach isn't always right, but it guarantees survival in the market. The Phantom's first trading rule largely protects your capital, but we're ultimately in futures markets to make money, how to maximize profits while minimizing losses. That brings us to the Phantom's second rule. Scaling in correctly and without exception is how you make big gains. Most traders, after seeing paper profits, impulsively cash out, fearing reversals that could wipe gains instantly. This is human nature in markets. But in trading, even instincts become obstacles. Traders often get emotionally hijacked, losing sight of the big picture, a major trading taboo. The Phantom constantly stresses changing behavioral habits. For implementing the second rule, focus on two key phrases: without exception and correctly. Without exception means you must add to positions whenever conditions are met. Regardless of hesitation, additions must be small and progressively smaller. For example, starting with 6 contracts, first add 4, second addition adds 2. After 2 additions, your original position doubles. The 3-to-2-to-1 ratio creates a pyramid scaling method, each addition smaller than the last. Whether long or short, trend extensions increase reversal risk. Smaller additions control exposure. Entry prices for additions depend on your trading system's signals. Sometimes Rule 2 doesn't apply. Many traders go all in immediately. This carries massive liquidation risks. Position scaling should be gradual, adding as the market evolves. Never max out your account, facing maximum risk from the start. This is definitely another horseshoe traders shouldn't touch. The Phantom's 2 trading rules are indeed scalding hot horseshoes. They work for both long-term and short-term trading, but crucially, must be used together. If market conditions meet scaling criteria, add positions once or twice, but exit immediately if the market suddenly reverses. Take our earlier example. A futures product opens at 600, your long entry at 605. If morning close stays above 608, hold per Rule 1. If the uptrend continues and an entry signal appears at 620, add a small position per Rule 2, but exit it immediately if the market reverses after adding. Say the next morning's close drops to 615, and apply Rule 1, close the added position. The original position entered lower still has approximately 10 points profit, so keep it. In short-term day trading, scaling opportunities are rare. For medium or long-term trades, scaling chances increase. Rule 2 works better here. But traders must avoid adding positions at inflection points. Inflection points mean market tops and bottoms. Adding longs at peak prices guarantees losses. Same goes for shorting at bottoms. The Phantom shared a tip with Arthur for spotting inflection points: hand-drawn point and figure charts. In today's computer age, few traders manually plot charts, but the Phantom maintains this habit. Many entry or exit signals come from his point and figure charts. Most traders know candlestick charts well, but might not recognize point and figure charts. Briefly, point and figure is another technical chart type. Its plotting method is unique. X's mark price rises, O's mark declines. When prices rise a set amount, you add an X. Conversely, when prices drop by a certain amount, just draw a circle on the grid. When you see a string of X's, it means prices are in an uptrend. When you see a string of O's, it shows prices are in a downtrend. The longer the string of X's or O's, the stronger the trend. The key to point and figure charts is the switch between X's and O's. For example, if a string of X's is followed by an O, it's time to flip from long to short, close long positions and open shorts. Conversely, a string of O's followed by an X signals flipping from short to long, close shorts and open long positions. The Phantom suggests traders try drawing point and figure charts themselves to better grasp the market. Netizens' responses to the Phantom's first and second rules are pretty interesting. One netizen named Alfred, a chess enthusiast, described the Phantom's rules like this. He said the first rule is like the opening in chess. It's most critical. You gotta defend smartly, and attack actively. The second role is like consolidating your position, using knights, bishops, and the queen to protect your king. Arthur praised this analogy. Actually, whether on the chessboard or in trading, many principles are similar. A good start is half the battle. If you botch the opening, the odds of losing the game are pretty high. Every move in chess is like opening, adding to, or closing positions in trading, all linked together. The Phantom's first rule applies after opening a position. Close it right away if it's wrong. The second rule is for adding to a confirmed correct position, but after adding, it circles back under the first rule's domain. If this addition is incorrect, you need to exit that part. So if the addition is correct, when do you take profits? That's what the Phantom's third rule tackles next. Simply put, the third trading rule is about exit timing. The Phantom believes that huge volume signals a prime chance to cash out. Huge volume usually means daily trading volume 5 times above average. 2 or 3 times is still moderate growth. The Phantom believes markets fluctuate between high and low activity periods. During low activity, we should question all signals while awaiting further confirmation. But during extreme activity with huge volume over 3 days, we should close all positions. Specifically, close half your positions immediately the day after huge volume appears, and close the remaining half over the next 2 days. Afterward, wait for new signals to prepare for the next entry opportunity. Following the Phantom's 3 rules creates a virtuous trading cycle. Getting trading on the right track. The Phantom hopes Rule 3 becomes second nature, a reflexive action to close at huge volume. Whether futures or stocks, peak volume at peak prices is universal. Here, Tin Liang, sky-high volume, means exactly what the Phantom calls huge volume. Exiting then preserves profits because uptrends often climax with volume spikes. If you don't exit, prices typically surge then crash, vanishing paper gains. Same for downtrends. They usually end with accelerated plunges, so decisive exits are crucial. Don't let that duck at your lips escape. Secure your victories. That concludes the Phantom's 3 trading rules. Quick recap. First, after opening positions, exit decisively if unconfirmed. Never rely solely on stop losses. Second, never go all in immediately. Scale in gradually only after confirming positions. Third, know when to cash in winners. Exit promptly at huge volume. Another common issue, emotional interference, especially for new traders who get restless. But in the Phantom's view, these emotional signals are actually useful for trading. For instance, if you're so overheated in deep winter that you unbutton your collar, you'd better close all positions immediately. Same if a ringing phone makes you agitated, close all positions fast. In other words, these emotional reactions are your exit signals. Trading is incredibly demanding work. Beyond the 3 rules, the Phantom offers daily life tips to help traders unwind. He suggests every trader keep their favorite book at their desk. When markets turn sour, read it to soothe your nerves. He knows a genius trader whose favorite is The Art of War. The Phantom believes Sun Tzu's 2,500-year-old principles still apply today, extending to business and trading. As for the Phantom himself, his most cherished book is the Bible. His biblical insight, we all must choose, but only one choice is right. Choosing disbelief leads to one outcome. Choosing belief leads to a completely different one. Just like in trading, making right decisions matters most. Another tip for new traders: find your lifelong idol, letting their spirit empower you to become who you admire. The Phantom says he's had several idols over the years. His current idol is younger than him, Oprah Winfrey, the famous American talk show host. Born in 1954, she's deeply revered by the Phantom as his guiding light. To the Phantom, everything Oprah does daily is pure giving and devotion. By choosing such an idol, the Phantom himself gradually grows closer to her example. This book is his selfless gift to traders, hoping it helps you join successful traders' ranks soon. Well, that's The Phantom of Wall Street. That wraps up our interpretation. Reading notes are below the audio. See you tomorrow.